Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today we're going to do a little video on cash secured puts. A viewer kind of asked about what exactly this is. I just didn't want to do a brief rundown about what this kind of like investing option strategy involves, and some kind of a little example of it for something that kind of makes sense to me right now.
Got it. Two Super Guys Trade Stocks. So I will say I do like cash secured puts, and I will be doing those if I have to cancel my short position.
Okay. Yeah, it's interesting that way. So this was a subscriber. Yeah, I actually see you commented on a few of our videos, so I do appreciate that. Figured I'd answer your question here. Cash secured put. Basically, the whole idea. So an option is a contract to buy or sell underlying security on or before a certain date at a specific price. Right. So the way you can kind of think about this, if you're going to use this kind of tool, is you have to go through a few steps here, right? You have to have kind of decided you wanted to buy a stock or ETF at a specific price, right? The way you did arrive at that conclusion is by doing your due diligence, right? This is something you can use if you're kind of a value-oriented person where, you've done an analysis on the company and you're like, I want to buy this, but I only want to buy it if it hits this price. So it can be almost like if you have like a market like limit order, buy order on a particular security. But this is a different way of doing it. All right.
Yeah.
You have to have enough cash to buy 100 shares because options trade in 100 share units, basically. All right. The other thing to kind of consider with this is there's tax implications for this because if you're selling short-term cash secured puts, now that is I'm not a tax advisor here, but that is actually a short-term like capital gain if it goes, unexercised. If it goes exercised, then it gets a little bit complicated where it actually gets enrolled into the cost basis of the shares, right? So an example of a stock that, from my own crappy like kind of analysis is in a realm where I want to start accumulating some more shares. I bought some Google already, I'm hoping to buy more. I'm trying to buy more Meta right now because it's just cheaper to me. But Google is one that is definitely on my radar, right?
Right.
And now that they've had the stock split, shares are a little bit more reasonable in terms of price.
Way more reasonable. Not
Yeah.
reasonable before.
Exactly. So when you pull up an option chart, this is from Charles Schwab here, you have both calls and puts. All right. The call is the right to sell the security at a specific price on or before a certain date. Put is giving you, would kind of the right to buy a security on or before a certain date. Right. All right. So in this right here, we're listed down as a strike price. We have bid and ask spread. We have the actual change. We have the number of volume, open interest, which is the number of contracts that are out there in existence right now. We have different expiration dates. Some stocks that are a little bit less desirable trade on a monthly basis as opposed to like weeklies when you're talking about something like a big name like Google or Alphabet. Now, typical kind of thought process is that you're really trying to capture this theta decay here, all right? A options value, the extrinsic value of it, options are made up of two kind of components that make up the price. There's an intrinsic value, which is like the actual value of cash money, like right now, that's built into it, and extrinsic is time value. All right, the extrinsic
Intrinsic
value,
intrinsic is cost of the shares. It's just literally the dollar value.
yeah. So
Makes
if
it
you were
easier.
buying an option that had some in the money portion of thereof, all right, we're talking about doing this for like an out of the money scenario where it'd be entirely extrinsic value. There is no intrinsic value on an out of the money option. This theta decay is time eroding the value of that option, and that's what you're getting as an option seller when you open a cash secured put. You're getting the ability to kind of enjoy this theta decay, right? People call this, is even a group on Reddit called Theta Gang, where people try to trade the strategy exclusively. So conventional wisdom, because you see the acceleration here in the state of decay as we kind of get down to the last couple months, most people will sell options in the 30 to 45 day range. That's kind of generally where you get the best kind of return on your investment, if you will, from a theta decay standpoint. So a real life example here, we're filming this in the beginning of December, 47 days out, close to that 45-day time period. This is once again this Google. When you look at the actual strikes that are available here, 100 is basically at the money. That's why they have this kind of color shaded area here. But you want to go, somewhere a little bit further away from that if you, based upon what your analysis and what your buy point is calculated, from your due diligence, right? So I did this as if I had done a $90 strike. right? That would pay me, as of last transaction, about $126. Pretty good open interest here. Look at that, 17,000 open contracts. That tells you that's one that's very liquid. People are trading it a lot, right?
Yeah, that's actually pretty solid premium.
I mean,
Not bad.
relatively, it all depends on what your kind of risk tolerance is. This is a website, optionscalculator.com. You can put in the actual option you're doing, the security that you're doing, and it'll give you this probability kind of table here, which shows if the stock is trading at a specific price by a specific date, what portion of the premium you would have expected to kind of receive at that point. Um, and it also will do other things here and tell you like what your likelihood of probability of profit is. So 87%. So it's telling you there's a 12.9% chance that you end up, being, kind of losing money on this transaction. So relatively low, 1 in 10, a little bit more than that, 1 in 8 actually. The maximum kind of return on risk here, and then you annualize that out, it'd be about 10.9% return. So theoretically, using this strategy, you could earn 11% on your money while you're waiting to go ahead and buy Google stock at your calculated price.
Right.
This is why it's a cool tool.
Just my quick 2 cents here. That 88% probability thing, don't rely on that. I can't tell you. I think I'm 5 out of 10, 99.8% successes failing. So the percentage does not calculate what's happening right now in our world, in our macro environment, or earnings, anything. It doesn't have any of that crap in it. So
Yeah.
act like that doesn't exist.
It's simply a statistical model built upon the actual like options implied volatility. That's what it's really built upon.
Yeah.
So ultimately, you do this trade here, of this cash secured put. You have 3 scenarios. What? One, the put expires worthless. Take it all the way to expiration date. Google never touches $90 a share. You get to keep that $126. Right? And you're free to sell another one at that point. The put gets exercised. At that point, basically, they've sold you now 100 shares of Google at a price of $88.74. It doesn't matter if Google is now trading for $33 a share. You bought it at $88.74.
That is the inherent risk of cash secured puts, is a total crash where no matter what happens, even if it's like exercised a way out and Google's now at $5, you are going to have to put up money at $88 a share. That's the crappy part of this. That's the biggest risk.
Exactly. And then there are scenarios where you could close early, right? Some people will say once 50% of the premium has been collected or kind of eroded away by theta decay, that they will close it, roll it out, and issue a new cash secured put. Some people will do that sort of strategy. It's a very reasonable thought. It's definitely something worth exploring, and it's an interesting tool to have in your kind of like skill set. What it's worth, I don't know. I've done it a couple of times myself, but it's not like changing the world by any stretch of the imagination, I would say.
One thing you can do that I did with Baba, for those of you who don't know, we're pretty big on Baba here, is I did cash secured puts until I had to buy, until it got exercised. So they were fairly risky because you get way more premium if you're risking it. And I want to buy it anyways. So if you have a stock where you're okay owning, like I own Meta, my average is like 125 or something. I'm completely okay with owning Meta at 125, so I'll be a lot more risky and therefore getting way more premium. Then, let's say it gets exercised, you could do covered calls in that money, getting even more premium, so it goes back and forth.
Yeah, do you know what that's called, doing both of those techniques?
The Dylan.
It's called the wheel strategy.
Didn't know that.
It actually does have a name. Yeah.
Oh.
You sell cash secured puts until you get assigned, and then you start selling covered calls until your share get called away, and then you go ahead and do a cash secured put again. It's called the wheel.
And I invented that.
Yep, totally.
It was me.
Patented.
Yep. TM, trademark. Subscribe button. There. We got to remember to do this more.
I love it. All right, catch you guys in the next one.